Welcome. In this video, we are going to see if Xcn coin can skyrocket from here. But if you don't watch until the end of the video, you might not understand. So sit back and listen carefully. Looking at the chart, we can see that the price has been moving in a downtrend for a long time. This downtrend has caused the price to continually make lower highs, and each attempt to move higher has been suppressed by sellers. This type of downtrend structure usually indicates that selling pressure is dominating the market, and buyers are struggling to push the price up. The fact that the price remains within this downtrend suggests that there is a significant obstacle to the start of a new bullish move. This is because the trend line acts as a strong resistance for the price, and selling from this level causes the price to pull back again. Therefore, in order for the price to start rising, it must first break this falling trend line upwards and hold on to it permanently. If the price manages to break the downtrend, this could be considered as a turn signal in the market, and buyers may be bolder and push the price upwards. However, the important point here is that the breakout should not only be with the wick, and the price should close above the trend line and provide permanence. Otherwise, the price may return back into the trend, and the downtrend may continue, as in the case of previous false breakouts. In order for the upward movement to strengthen after a downtrend breakout, the volume should also be supportive. This is because a breakout without volume is usually weak, and may cause the price to retreat back into the downtrend. Therefore, the buying volume that comes with the trend breakout should be carefully monitored. We can't know that the price is going to skyrocket only on trends. We need to look at other metrics as well, so keep watching. When we look at price movements according to the Elliott wave theory, we see that the first and second waves are now complete and are about to enter the third wave. Elliott wave theory is a method of analysis used to explain fluctuations in the markets and suggests that price movements follow a certain pattern. According to this theory, there's either a 5-wave uptrend or a 3-wave correction. In the current scenario, the first wave started as an uptrend and was followed by a correction in the second wave. However, the most critical point here is where the second wave will stop the price. Because according to Elliott wave principles, the second wave should not go below the starting level of the first wave. If the second wave dips below the level where the first wave started, then the Elliott wave count is invalid and cancelled. If the second wave is completed according to the rules, the third wave, known as the strongest move, is next. In Elliott theory, the third wave is usually the longest and one of the strongest bullish moves. This is because it's the point at which the market sees the highest volume and strongest buying interest. When the third wave begins, price action accelerates, momentum increases, and new highs are formed, often surpassing previous highs. Fibonacci levels are an important indicator at this point. In Elliott wave analysis, the target of the third wave is usually set at the 1/618 Fibonacci level, and this point is a minimum level. And if we can see more voluminous candles, there is a chance to go to higher Fibonacci levels. Another important formation on the chart is the W pattern. In technical analysis, this pattern is also known as a double bottom and is often considered a harbinger of trend reversals. The W pattern is a structure in which the price reacts upwards by bottoming twice at a certain support level and then starts to rise. Looking at the price action right now, we can see that the pattern is at the second bottom. The second bottom is the most critical point in the W pattern, because this is the zone that determines whether buyers will step in or not. If the price holds here and reacts strongly to the upside, the validity of the pattern increases and the targeted bullish move can begin. The bullish move after the first bottom may have attracted investors' attention and pushed the price higher. However, after this bullish move, the price retraced back to the second bottom. This second bottom is often considered as a final test in the market. If the price encounters a strong buying reaction here, the resistance level called the neckline will need to be broken to complete the W pattern. For the W pattern to be fully confirmed, it is critical for the price to break the neckline to the upside. The neckline is usually the high reached by the bullish move after the first bottom. If the price breaks this level on volume, the pattern is considered complete, and the bullish target is calculated by traveling the distance between the bottom of the pattern and the neckline upwards. However, there are important points to note here. First of all, it is ideal that the second bottom does not fall below the first bottom. If the second bottom is lower than the first bottom, the validity of the pattern may be reduced, or a different analysis may be required. And if the price breaks the neckline of the pattern, the price will move towards where the pattern started. Looking at the current price action, one of the most notable structures at this level is the presence of a bullish order block. A bullish order block usually refers to levels where large buyers have previously traded heavily and created a strong support zone in the market. Such zones are areas where the price reacted sharply and are strategic points where buyers can re-enter the market. The fact that the price is currently at the level of this bullish order block suggests that this could be a strong support area. In particular, the fact that the price has started to move sideways at this level suggests that sellers have lost their strength and buyers are likely to step in. Also, due to the nature of order blocks, if the price moves up from here, a short-term bounce may be seen in the first place. However, the key is whether this bounce will strengthen and the price will be able to break the downtrend. If the bullish order block works as a strong support, the price may start moving higher from there and test the nearby resistance levels first. Whether there is an increase in volume during this process will also be an important indicator. However, if the price fails to find enough buyer support at this level and sellers become dominant again, a breakout of the order block should not be ruled out. If the price dips below this zone, a deeper bearish wave may begin. In particular, it would be healthier to evaluate possible scenarios by looking at how the price has reacted in this region before. We will see how it will react to this order block. When we analyze the price action, we can see that the bearish order block is an important structure that attracts attention in the upper region. The bearish order block is usually one of the areas where large sellers trade heavily in the market, and the price reacts sharply. Such zones form important resistance levels where the selling pressure is strong, and the price may face when it moves higher. The price is currently moving below the downtrend, but if it can break this trend to the upside, it will naturally have the potential to move towards the bearish order block at the top as the first target. Should this move materialize, it will be critical to see how price reacts to touch the order block. If it encounters a sharp selling pressure when it reaches the bearish order block, the price may be rejected here and move down again. However, if there is volume buying when the price hits this order block and sellers fail to break the pressure in this area, this level could be breached and higher levels could be targeted. Still, due to the nature of order blocks, they are usually more likely to receive a strong reaction at the first contacts. Therefore, it is necessary to carefully monitor how the price will react once it reaches this zone. Another important scenario is that after reaching the bearish order block, the price may sell sharply and fall back downwards. If this happens, the price is more likely to retest the downtrend that it broke first, and after retesting, it is more likely to break the order block a second time. Looking at the RSI indicator, we can see the presence of an important rising trend line supporting price action. In the current case, the RSI is observed to have bounced off this rising trend line several times before, moving to the upside. Such reactions suggest that the trend line is working as a strong support zone, and buyers step in when they hit this level and move the price up. So, it's clear that each time the RSI makes a turn, when it approaches the trend line and continues its uptrend. In its most recent move, we notice that the RSI is again approaching this trend line and bouncing off it, gaining momentum to the upside. This suggests that, as in the past, buyers have re-engaged and the market continues to hold this support level. If the RSI continues to stick to this trend line, it could give an important signal that the bullish potential of the price remains. However, there is a critical point to note here. Even though the RSI has successfully bounced off the rising trend line, one should not ignore the possibility of a breakout of this trend. If the RSI breaks this rising trend line to the downside, it could signal a loss of momentum and cause the price to trend negatively. In particular, if the RSI breaks below the trend line and stays there, it could be an indication that sellers are starting to dominate the market. And if the RSI goes to the highs from here, the price will break the downtrend and we will see a nice rise. Looking at the MACD indicator, an important reversal signal in price action is about to occur. The MACD line and the signal line are starting to converge below the zero level. This type of pattern is usually considered a bearish one, indicating that the price has already experienced a decline and may now enter a rebound. If the MACD line makes a crossover above the signal line, and this crossover occurs below the zero line, this is usually considered a weak bullish signal. However, if momentum increases with this crossover and the MACD crosses above the zero line, this may indicate that the uptrend may be stronger. Such crossovers usually signal that the price has formed a bottom and the trend may turn upwards. Notably, when the histogram bars also cross into positive territory near zero after the MACD line makes an upside crossover, it is an additional confirmation signal that the price may enter an uptrend. Once this crossover happens and it goes above the 0 point, we will see a nice uptrend. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.